3 years ago, Sarah walked into two identical apartments in the same city on the same day. Both had 3 bedrooms, 2 bathrooms, roughly the same square footage, and similar views of the skyline. One was listed at $350,000, the other, $900,000. She stood there, completely baffled, wondering if she'd missed something obvious. The real estate agent smiled and said something that would change how Sarah understood property forever. The price of a home has very little to do with the home itself. That statement might sound absurd at first. After all, when we think about why properties cost what they do, we immediately think about the obvious things. The size, the number of rooms, whether it has a garden, if the kitchen has been renovated, the condition of the paint on the walls. These are the factors we see, the ones we can touch and measure. But here's the truth that the real estate industry doesn't always make clear. These visible features might account for only 30 to 40% of a property's actual value. The rest, it's determined by forces that most buyers never even think about. Invisible hands that push and pull prices in ways that can seem almost magical until you understand what's really happening. Think about it this way. If property prices were really just about the physical structure, then every 3-bedroom house of similar age and condition in a country would cost roughly the same, adjusted maybe for local labor and material costs. But we know that's not even close to reality. A 3-bedroom house in one neighborhood might sell for $200,000 while an almost identical structure 5 miles away commands $2 million. The difference isn't the bricks and mortar, it's everything else. And once you understand these hidden factors, you'll never look at property prices the same way again. Let us start with something that seems obvious but is far more complex than most people realize. Location. Yes, everyone knows location matters. It's the oldest cliché in real estate. But what actually makes a location valuable? It's not just about being in a nice area or a good neighborhood. Those are surface-level observations. The real question is why some locations become valuable in the first place, and why that value can change dramatically over time. The answer lies in something economists call spatial economics, and it's governed by factors that most homebuyers never consciously consider. The first hidden factor within location is proximity to economic opportunity. Cities and neighborhoods don't develop randomly. They grow around economic engines. In the past, this meant ports, railroad stations, factories. Today it means business districts, tech hubs, university campuses, medical centers. When a major employer decides to build a headquarters in an area, property prices within a certain radius begin to rise immediately, often before a single brick of the new building is laid. This isn't just because people want to live near their work. It's because economic activity creates a multiplier effect. That headquarters needs restaurants, gyms, dry cleaners, coffee shops. Those businesses need employees. Those employees need housing. Suddenly you have a cascade of demand that pushes prices upward. But here's where it gets interesting. The distance decay function, as urban planners call it, means that property values don't increase uniformly around these economic centers. Instead, they follow a complex pattern based on transportation networks, natural barriers, and existing development. A property that's 3 miles from a major employment center but right next to a subway station might be worth more than a property just 1 mile away that requires a car and a fight through traffic. This is why you'll sometimes see property prices that seem to make no sense until you overlay a map of transportation infrastructure. The hidden factor here isn't just location, it's connectivity. Then there's the concept of agglomeration benefits, which sounds technical but is actually quite intuitive once you understand it. Certain industries and activities cluster together because they benefit from proximity to each other. Think about how tech companies concentrate in certain areas, or how financial institutions cluster in specific districts, or how creative industries gather in particular neighborhoods. When you buy property in or near these clusters, you're not just buying proximity to one company or one industry. You're buying into an entire ecosystem that tends to be resilient and self-reinforcing. Even if one company leaves, others remain, and new ones are attracted to the existing concentration of talent and infrastructure. Another hidden location factor is what urban economists call option value. This is the value that comes not from what's in an area now, but from what could potentially be there in the future. A property near undeveloped land that says zoned for commercial use has option value because that land could become something valuable. A property near a proposed transit line has option value even before the line is built. Smart investors understand this and buy based on potential, not just current reality. This is why you'll sometimes see properties in seemingly unremarkable areas selling for surprising prices. The buyers aren't paying for what's there now. They're paying for what they believe will be there in 5 or 10 years. Now let's talk about something that has an enormous impact on property prices but that most people never think about directly. Zoning and land use regulations. These are the rules that determine what can be built where, how tall buildings can be, how much of a lot can be covered by structures, whether a property can be used for business or only residence. These regulations are created by local governments and they have the power to make some properties incredibly valuable while severely limiting the value of others. Here's the key insight. Restrictive zoning creates scarcity, and scarcity drives up prices. If a city has regulations that make it difficult to build new housing, then the existing housing becomes more valuable because supply cannot easily increase to meet demand. This is why you see such dramatic price differences between cities with similar economic profiles but different regulatory environments. Cities with strict height limits, large minimum lot sizes, lengthy approval processes, and community veto power over new development tend to have much higher property prices than cities with more permissive zoning, even when wages and job opportunities are comparable. But zoning doesn't just affect overall price levels. It creates very specific patterns of value within a city. Properties that are zoned for mixed use, allowing both residential and commercial activity, often command a premium because they offer flexibility and higher income potential. Corner lots in commercially zoned areas are worth more than mid-block lots because they offer better visibility and access. Properties that have been grandfathered in under old zoning rules, allowing uses that new regulations would prohibit, can be worth significantly more than seemingly similar properties nearby. There's also something called downzoning and ups, which can dramatically change property values overnight. When a government decides to allow denser development in an area, properties there suddenly become more valuable because each piece of land can now support more housing or commercial space. The opposite happens with downzoning. If regulations become more restrictive, limiting what can be built, existing structures might become more valuable due to increased scarcity. But undeveloped land becomes less valuable because its development potential has been reduced. Let's just move to another hidden factor that most people don't fully appreciate: interest rates and the availability of credit. When people think about whether they can afford a property, they naturally focus on the price tag. But what really determines affordability isn't the price, it's the monthly payment. And the monthly payment is determined largely by interest rates. This creates a fascinating dynamic where property prices and interest rates move in opposite directions. When rates are low, people can afford to borrow more, so they bid out property prices. When rates rise, people can afford to borrow less, so prices tend to moderate or fall. But here's what makes this really interesting. This relationship isn't just about individual affordability, it's about how cheap credit drives investment behavior. When interest rates are very low, traditional safe investments like bonds and savings accounts offer minimal returns. This pushes investors to look for higher returns elsewhere, and real estate often becomes a favored destination for this capital. Wealthy individuals, investment funds, and even foreign buyers flood into property markets seeking returns that they can't get from safer investments. This investor demand adds another layer on top of organic demand from people who actually want to live in the properties, pushing prices even higher. The availability of credit matters too, not just its cost. During some periods, banks are willing to lend to almost anyone with minimal down payments and relaxed income verification. During other periods, lending standards tighten dramatically. These credit cycles can cause property prices to swing wildly even when underlying economic conditions remain relatively stable. A property might be worth a certain amount when banks are lending freely, but if credit suddenly becomes harder to obtain, the pool of potential buyers shrinks and prices adjust downward. The property itself hasn't changed, but the financing environment has, and that's enough to shift value significantly. There's also the matter of mortgage products and financial innovation. The introduction of new types of mortgages, different loan terms, or government-backed lending programs can all affect property prices by changing how much people can borrow or who can access credit. When these products make borrowing easier or more attractive, they tend to push prices up. When financial crises lead to the elimination of risky mortgage products, prices often correct downward. Now, let's discuss something that operates at a much larger scale: demographic trends and population dynamics. Property prices are ultimately driven by the balance between how many people want to live in an area and how much housing is available. This seems simple, but the demographic factors that drive this balance are incredibly complex and play out over decades. Consider age demographics. In many developed countries, large generations like the baby boomers are aging and beginning to downsize from family homes to smaller properties or retirement communities. At the same time, younger generations are forming households and looking for homes. The size and economic power of these different cohorts creates waves of demand that move through the market over time. When a large generation reaches prime home buying age, typically the late 20s to early 40s, it creates sustained upward pressure on prices. When a large generation ages into retirement, it can create selling pressure on certain types of properties while increasing demand for others. Migration patterns matter enormously too. People move for jobs, education, lifestyle, and climate. Cities that are net recipients of migration see consistent upward pressure on property prices because new residents increase demand while it takes time for supply to adjust. Cities that people are leaving often see stagnant or falling prices even if the properties themselves are perfectly good. These migration patterns can shift surprisingly quickly based on economic restructuring, climate change, remote work trends, or quality of life factors. There's also international migration and foreign investment, which has become increasingly important in a globalized world. In many major cities, a significant portion of property demand now comes from foreign buyers who are looking for safe places to park capital, second homes, or properties for family members studying or working abroad. This demand is driven by factors in other countries, things like political instability, currency concerns, or wealth accumulation in emerging economies. A Chinese investor's decision to buy property in Vancouver or Sydney might be driven by regulations in Beijing, not anything happening in Canada or Australia. This means property prices in global cities are now connected to political and economic events on the other side of the world. Let us talk about something that might seem abstract but has very concrete effects on property prices: the broader economic environment and how it affects wealth and income. Property prices don't exist in isolation from the overall economy. They're intimately connected to employment rates, wage growth, corporate profits, stock market performance, and wealth accumulation patterns. Here, as a crucial insight that many people miss, property prices are often more closely correlated with wealth than with income. A high-income doctor or lawyer with significant student debt and no family wealth might struggle to buy an expensive property, while someone with a moderate income but substantial inherited wealth or stock market gains can easily afford the same property. As wealth inequality has increased in many countries, with asset owners seeing their wealth grow much faster than wage earners see their incomes rise, this has created a divergence where property prices in desirable areas have pulled away from local incomes. The properties are being bought by people whose wealth comes from other sources: previous property ownership, stock portfolios, business ownership, inheritance. This creates what economists call a wealth effect. When people feel wealthy because their assets are increasing in value, they spend more and are willing to pay more for property. This can create self-reinforcing cycles. Rising property prices make property owners feel wealthier, which encourages them to spend more and invest more in property, which pushes prices higher still. The reverse can also happen. When asset prices fall, people feel poorer and pull back on spending and investment, which can accelerate price declines. The structure of the economy matters too. Economies that are heavily weighted toward high-paying knowledge industries like technology, finance, and professional services tend to generate more demand for high-end property than economies based on manufacturing or agriculture. This is partly about wage levels, but also about the structure of compensation. Technology workers who receive stock options that become valuable, finance professionals who receive large bonuses, entrepreneurs who sell businesses. These are sources of wealth that can drive property demand far beyond what salary alone would suggest. Let's examine another hidden factor that has become increasingly important: the investment and speculation cycle. For most of human history, property was primarily a place to live or conduct business. It was valuable, but it was fundamentally a use asset. Over recent decades, property has increasingly become treated as an investment asset, something to buy and hold for appreciation or to generate rental income. This shift in how property is perceived and used has profound effects on pricing. When property is seen primarily as an investment, its price starts to behave more like a financial asset. Investors look at metrics like rental yields, capital appreciation potential, and comparison to other investments. They're willing to pay prices that might seem absurd from a use perspective because they're not planning to use the property themselves. They're counting on being able to rent it out or sell it later at a profit. This investment demand adds to organic use demand, pushing prices higher than they would be if everyone buying property planned to live in it. This creates conditions for speculation, where people buy property not because they think it's reasonably priced for its use value, but because they believe prices will keep rising and they can sell to someone else at a profit. This is sometimes called the greater fool theory. You might be paying a foolish price, but as long as you can find a greater fool to buy from you later at an even higher price, you'll profit. When speculation takes hold, prices can rise far above levels justified by fundamentals like rents and incomes. Eventually, when prices get too high or economic conditions change, speculation can reverse rapidly, leading to sharp price corrections. The globalization of property investment has amplified these dynamics. Property in major cities is now part of a global investment portfolio for wealthy individuals and institutions around the world. This means that property in London, New York, Hong Kong, or Dubai isn't just competing with other local properties. It's competing with properties, stocks, bonds, and other investments worldwide. A property's price might be driven up by an investor in another country deciding to shift allocation from emerging market stocks to developed world real estate. These investment flows can be enormous and can drive prices in ways that have little to do with local economic conditions. Now let's consider something that's often overlooked: the quality and availability of public services and infrastructure. When people evaluate a property, they naturally focus on the property itself. But what they're really buying is access to a bundle of services and amenities that the property provides access to. This is why two identical houses in different cities or neighborhoods can have vastly different values. School quality is one of the most powerful drivers of property prices in areas with families. Parents will pay extraordinary premiums to live in areas with highly rated public schools. This creates a fascinating dynamic where property prices and school quality reinforce each other. High property prices generate high property tax revenues, which fund better schools, which attract more families willing to pay high prices, which generates more tax revenue. Areas with good schools can command price premiums of 30, 40, even 50% over similar areas with weaker schools. But it's not just schools. Access to quality healthcare facilities, low crime rates, well-maintained parks and public spaces, efficient public services, these all contribute to property values. The interesting thing is that these services are often funded by property taxes, creating a direct link between the taxes paid and the value received. Areas with well-functioning local governments that provide good services efficiently can sustain higher property values than areas where governance is poor or services are inadequate. Infrastructure investment can transform property values seemingly overnight. A new subway line, a highway interchange, a bridge. These investments change accessibility and connectivity in ways that directly translate to property values. Properties that were remote or difficult to reach suddenly become accessible. Commute times that were unbearable become manageable. These changes in connectivity can cause property values to spike. And smart investors watch infrastructure plans closely to identify areas that will benefit from upcoming improvements. There's also environmental quality, which has become increasingly important as people place more value on livability and health. Air quality, noise pollution, access to green space, proximity to water, walkability. These environmental factors all affect property values. Areas with better environmental quality command premiums, while areas with environmental problems see values suppressed. Climate change is now adding another layer to this, with some areas facing increased risks from flooding, wildfires, extreme heat, or sea level rise. These climate risks are beginning to be priced into property values, with vulnerable areas seeing slower price growth or even declines as the risks become more apparent. Let's talk about something that operates at a very local level but can have outsized effects: neighborhood dynamics and social factors. Property values aren't just about economics and infrastructure. They're deeply influenced by social perceptions, cultural factors, and neighborhood identity. So here's what we've uncovered. Property prices are determined by a complex web of factors that extend far beyond the physical characteristics of the buildings themselves. Economic opportunity and connectivity, zoning and regulations, interest rates and credit availability, demographic trends and migration patterns, wealth distribution and economic structure, investment and speculation, public services and infrastructure, environmental quality, neighborhood dynamics and social factors, and technological change all interweave to create the prices we see. Sarah, who we met at the beginning, eventually understood why those two seemingly identical apartments had such different prices. One was in a neighborhood where zoning allowed dense development, near a new tech campus, with excellent schools and a subway station, in a city where foreign investment was strong. The other was in an area with restrictive zoning, declining employment, underfunded schools, and limited transportation options. The apartments themselves were similar, but everything else was different. For anyone trying to understand property prices, whether you're buying your first home, investing in real estate, or just trying to make sense of market movements, the key insight is this: don't look only at the property. Look at everything around it and everything that affects it. Look at where jobs are growing and where infrastructure is being built. Look at what regulations allow and what demographics demand. Look at how the economy is structured and how wealth is distributed. Look at whether an area is improving or declining, and try to understand why. Property prices will always seem mysterious if you focus only on what you can see and touch. But once you understand the hidden factors, the invisible forces that really drive values, the market becomes less mysterious and more logical, not perfectly predictable, because there are simply too many variables and too much complexity for that, but understandable in a way that can help you make better decisions. Whether you're deciding where to buy, when to buy, or how much to pay, understanding these hidden factors gives you a framework for thinking about value that goes deeper than square footage and counter. And in a market where the difference between a good decision and a poor one can be hundreds of thousands of dollars, that deeper understanding can make all the difference.